Sam, Anthony, welcome to the Value Perspective podcast. It's a pleasure to have you here. Maybe you could provide us with a little bit of background on how Value Capital Partners was started and what led you guys to launch what, you will correct me if I'm wrong, a very value activist concentrated strategy operating in South Africa.
Our background is in private equity. So Anthony Bo was actually the co-founder of the first private equity fund in South Africa, BREIT, in the late 80s. So many years of private equity experience. And we started working together around 2008. And at that particular stage, about 3 years later, BREIT changed from being a multi-manager of assets into an investment holding company. And became quite successful, listed on the JSE with a secondary listing on the Luxembourg Stock Exchange. And the two of us wanted to find the next best thing. So we thought this would be a great opportunity to launch something new in the South African space and to plug that gap where you've got, you don't have a shareholder of reference on listed businesses when something, starts to go wrong. So we saw that as a great opportunity. But we weren't really sure whether it would really work or not in South Africa. So part of what we did was we took a trip to the USA in November 2016, as well as to Europe, and we met with Value Act Capital, just to understand their processes, how they work. We also met with a few activist investors on the East Coast, which was really great. And then we took the trip to Sweden to meet with the founder of Servian Capital, who was also quite gracious to meet with us. When we came back in November 2016, we were really confident that this is a model that could work in South Africa, but tweaked to the local peculiarities of South African markets.
That's really interesting, and actually, it's a great segue to our first question, which is, how do you think about the process of activism in a place like South Africa?
I think our trip to the US and also reading some books around how activist investing is done in the US taught us certain things that wouldn't work in South Africa. For instance, I think when you read books like Dear Chairman and Barbarians at the Gate and stuff like that, there's a saying that the world is a small place. Everyone is about 2 or 3 calls away. But in South Africa, it's even smaller than that. So writing letters to the media and trashing the CEO, those things won't work in South Africa. So it's more of a collaborative approach that we have seen works in South Africa. I think the number of years and deals that we had also done as private equity in South Africa gave us the networks to be able to attract people that we can partner with. So when we invest in specific industry, we look for industry experts to guide us in terms of how to actually unlock the value. So when you have worked in the capital markets in the private equity space with lots of founders of businesses, it helps. So for instance, our first deal, I can talk about it because it's in the past, Outron, was because we had worked with the Fenter family for a long time as BREIT, sold them businesses, considered different things with them. So having a discussion with them was much easier because it came from a relationship perspective. So I'll probably say the biggest difference would be the importance of relationship in a South African context and making sure you take a collaborative approach. But I'll also ask Anthony to weigh in here.
Thanks, Sam. Just 1 or 2 other points. I think another one is the percentage ownership is also different. As you go into smaller capital markets, one finds that ownership is more concentrated. I think you'd find the same in New Zealand or Australia, but certainly here as well. So whereas the big activists in the US, if they've got 1% or 2%, they throw their weight around. Here, you kind of start at 5 and you probably end up at 15 or 20. Given that there will be other institutional shareholders that are big holders. And typically, any big listed company in South Africa, you'll find 5 or 6 people that speak for control. So I think understanding that dynamic and working with it is quite important. And so I think one of the things that Sam and I have learned from our experience here is that the changes are more profound than we anticipated at the beginning. is once you get into these companies, you may find the work that's needed to get them to where you want to be is greater. But that dovetails into Sam's first point, is that we've managed to do all of that without media intervention, use of media, use of tools. It's all happened rather quietly behind the scenes, which is probably a cultural trait that's quite South African that we need to respect as well.
Could I just ask then, just following on from that, what type of personality do you think you need to be a more sort of private equity or activist investor, and how does that differ from your traditional sort of asset managers who were working on equity markets?
So when we started our business, we thought, what we're going to be doing is really just private equity in the listed space. So our pool of people should come from private equity, and it didn't work out that way. And I think a big part of it is because, when we do deals in the private equity space, most of them will be private businesses, and it's really an agreement between you and the owner and probably your lenders around the table, and deals get done. But at the end of the day, you need to have a collegial relationship with the board so that they feel that they are running the company. And you also need to be tough at times and to have those discussions, but do it in such a way that you're playing the ball and not the player. So all these brings a lot of different characteristics that you need in that person. So it's been a great learning curve for us. And so when we started, we didn't really have a sophisticated way of finding the right people for the role. But now you'll find that we've got case studies, we've got psychometric tests, we've got extensive background tests to find the right type of person who will succeed in an activist type model. And I think we're getting there. We've got a stable team now, and any one of us can go onto the board and doesn't need myself and Anthony to be there. So which is a great place to be.
Because I was going to ask, do you think it's a kind of natural instinct in the people that you're recruiting, the type of behavioural things that you've just described, or do you think it's something that can be learnt on the job?
I think it's a bit of both. I think certain things you wouldn't have done them before, but what we probably look for is that if you don't have that, do you have the capacity to learn that and to upskill in that particular regard. I'll probably also add a caveat. What we've also realized is that what you also don't want to do is end up with, let's say, 10 or 12 directors who think and act exactly the same, right? Because then that also leads to pitfalls. So part of what we are doing now is sometimes you need to be able to find someone who is just really good at equity markets, and they don't necessarily want to be on the board, right? But that will pose as a sense check when you are making decisions around the table. And someone who's got a different particular skill set, whether it's analytical or a contrarian view, or they've been a hedge fund person and they can see certain things that the team doesn't see, but they don't necessarily enjoy, being on the board. So I think we've now created that capacity, but the core of the team has to be sort of the factors that I mentioned at the beginning.
When you're looking to select an investment to go into, is there a sense that some companies are easier to change than others before you invest, and does that have to relate to some of the upside that you're looking for when you're making the investment itself? Yeah,
Rolo, you seem to be picking on all the questions where we've had deep pain and deep learning in our 5-year journey. I think certainly now I can certainly say that. I think when you come from a private equity background, a failed investment, you can know it at the beginning, but it probably becomes apparent maybe 3-4 years after you've invested in it, because part of it is you do your own evaluation of your portfolio companies. But in the listed space, the judgment is on a daily basis. So the moment a company produces results, your portfolio can fall by 20, 30, 40%, right? And a big part of what we've learned from that is that in the listed space, investors are quite jittery about stretched balance sheets. They are quite jittery about potential capital raises. So when you are looking for a potential investment, if you can, you should avoid ones that are stretched balance sheet wise, or where there's a capital raise required. And the main reason is it won't give you time to actually make the changes that you require, because you're trying to worry about the balance sheet, but you're also trying to change the strategy or trying to sell assets and all that. So it doesn't give you much time. The other thing that we've sort of learned through this journey has been the depth of management. So yes, activist investors are supposed to be active, but at the end of the day, management run the business. They run the business on a day-to-day basis. And if you don't have good management, it's very difficult to keep things on track, because by the time you come after a week or a month later, there's another crisis. Whereas when you find really good management, you find that things just get done, and they've got new initiatives. They're able to forecast things. They're able to deal with the crisis. So I think those two things are probably things that I would say we've found that if you can, you want to avoid that, but sometimes you can't, because that's where the opportunity is.
When we speak about what we do, we are looking for companies that have got inherent strength. So we're not looking for broken companies. But companies that have inherent strength, but have a need for a combination of governance, leadership, or strategy change. Now, we don't want companies that need all three of those things at the same time, because they're quite hard things to. So in our portfolio, we have about 2 of those at the moment. So you can tolerate a certain amount. You can tolerate a certain amount, but this really smart thing in our view is to find a company that's a small tweak does the value unlock. We don't want too many of these that require, complete overhaul of the board, complete overhaul of management, a complete overhaul of strategy, because it really is absorbing in terms of the bandwidth of the firm and of the senior people and the capacity of the organization. And we keep on saying that, our fantasy is to find that thing that requires minimal intervention and minimal change, and then off you go. It hasn't come across our path yet, but we'll find it.
How different is, or has been, the experience over the last 4 to 5 years running Value Capital versus what it was running Braid?
I'll just make 2 points. One is that one of the great advantages of this model versus private equity is that private equity, it takes about a year or 18 months to actually onboard the investment. And by the time you've gone through the process of making an acquisition, and probably about the same amount of time at the back end. So you've got a shortening of both of those processes, because you can buy the shares and you can sell them in the market when you choose to do so. So you've got that inherent advantage. The other thing I'll point out by way of difference, and it does get back to the question about what kind of people work here, is in private equity, you generally have a fuller deck of information to work off. When you make an acquisition, it's become more customary now than it was in my time, but even then, you have extensive due diligence. You can get whatever information you want before you make your investment decision. And typically it's commercial due diligence and financial due diligence. And in this world that we're in, you're going all on publicly available information. So your information deck is much lighter. And what that means, as we found, is a critical difference in terms of this business and the kind of people that are successful at it. You need to get conviction on less information. And that's a personality psychological trait that is often different between private equity people and hedge fund people. So we're looking for something in the middle of that, where people can get deep conviction based on what's available in the public domain.
The business positions that you're taking are very large, as you've already mentioned, anywhere between 5 to 20% of the company that you're looking at. So just thinking about the clients and them putting money into the fund, it is perpetual. But then do you think about, potentially walling clients from taking money out? Because if there was a rush to redeem capital, then how do you think about managing those positions that are quite illiquid? I'm hoping that would never be the case. Obviously, we don't have another financial crisis ever again. But these things are, I'm sure you've thought about.
I think what complicates things is also not only the fact that it's a liquid position, but also we sit on those boards. And in the South African context, when you are selling shares as a director, you have to be publishing SENS announcement every time. So obviously that will be negative for the share price and for the company. So when we when we started the business, we sat down and said, how do we manage this risk? So what we came up with is we've asked our investors to have a 3-year lock-in period where, when they invest in the asset, they can't disinvest for 3 years. If they do, there will be a penalty for them to do that. And I think that works well. Like I said earlier, it probably takes us, between 18 months to 3 years for our changes to start coming through. So you need that 3-year period for you to be able to do that. What also works in our favor is that the vehicle that we use in South Africa, we call it the Qualified Investor Hedge Fund, which is a collective investment scheme or a unit trust. And what it does is that if there's a redemption of, let's say, more than 25% of the fund, you are allowed to suspend any withdrawals, and it gives you a certain period of time. I can't remember, 3 to 6 months, in which to actually orderly sell the assets before you have to redeem, so that you protect the other investors that remain in the fund. So we think that with those two mechanisms, we are able to avoid a situation where there's a run on the fund.
And then the other question, just around this illiquidity point, I think you were mentioning, earlier about, having 1 or 2 or 3 maybe other big investors within the company. You've got quite concentrated and big asset managers in South Africa. So what's the relationship like with them when you're trying to enact change? But also, how do you sometimes persuade them to basically sell chunks of businesses to you guys in the first place?
I think what we've been able to demonstrate in our early investments is that once you've got a director or a shareholder who sits on the board and is part of the, let's say, investment committee where the capital allocation decisions are made, also part of the remuneration committee, and you make sure there's alignment with the management, things tend to happen much quicker. And the other asset managers have seen that value in our model. So for quite a significant number of investments that we have made, we've been able to go to them, present to them our idea of the value unlock, where we see the opportunity. But because these things are quite illiquid, and make them realize that the only way we are able to actually execute is if they sell down part of their shareholding to us at market value, and they've been able to do that. So because it's been a mutually beneficial relationship. So when we did our first investment in Outron, for instance, the 2 biggest shareholders owned about 58% of the company. And there was no liquidity. So we had to convince them to issue a fresh issue of shares to us at those low prices for us to gain 14% of the company. And they did that. But since we've been invested in the company, the share price has gone on, I can't remember the number, but we've done over 50% internal rate of return, and already returned almost 3 times of that investment in dividends to shareholders. So I think track record as well helps to be able to convince the other owners of the shares to sell down.
Yeah, so I guess that initial first pitch must have been very difficult, and now as you've gained track record, then I guess it becomes easier and easier, hopefully over time. Interesting.
Yeah, a few tempers were lost, and it was a difficult discussion.
Once you identify the company, you start to try to build up the position. How do you manage the uncertainty of actually being able to convince all of those stakeholders that VCP will be able to add value in a way that it will be positive for all involved? And how do you go about that mental process in case that it doesn't go the way that you expect?
What we think about when we are going through that process is downside risk, right? And our margin of safety. And that's why we spent quite a lot of time, testing our assumptions, testing, our hypothesis around the particular asset. And it's also quite important that we give ourselves enough time. So it's typical for an investment that we eventually make. I mean, I can mention because we've made the investment. So let's say for an investment like Net1, we looked at it for a full 3 years before we bought a single share, because we just didn't think that there was enough margin of safety, or we were protected in terms of the downside risk. And by the time we then got conviction around that, the share price, I think, was trading at about $3.50 or $3 per share, and the cash on the balance sheet was $4. And you also had businesses within the asset. So at that particular point, we knew that even if this thing goes belly up, we still get more cash than what's actually sitting on the balance sheet. So a big chunk of it is downside protection and the intrinsic value to get that margin of safety that we should. It talks to extensive research, knowing the industry, knowing the trends that are happening within the industry, or what we should be anticipating. It also means we have to talk to a lot of industry experts in that industry, because they would have seen this business through the various cycles, right? So that we don't ignore anything that might be coming around the corner. And as part of that, we then talk to other shareholders using publicly available information. So I think it's really saying, are we missing something? And let's make sure that we've got downside protection.
At that point where you have identified the business and you start to build up your position, you don't know if you're going to get access to the board. You don't know if you're going to be able to strengthen the management of the company. You don't know if you will be able to put someone on the compensation committee. So how do you think about that specific period of uncertainty?
Before we buy a share, right, we're looking at the prevailing market price of that share versus what we think is the intrinsic value. And we're asking ourselves and say, is there enough downside protection, right, before we even buy a share? Some businesses, we're quite happy not to be on the board, as long as we've got access to management and we can still talk to them about, the things that we require. I remember when we spoke to, I think it was Value Act Capital, where they were saying that you also need to realize that there's an inherent risk by being on the board, because the closer you are to the company, the more you get influenced by what management say, and there's certain risks that you won't see, right? So equally, if we believe an investment is a great investment and we can still have access to management and we can meet with them quarterly or every 6 months and be able to influence things, we'd still consider that to be an investment as well.
Can I just ask about the process around exit from investments? Because if there's your core, I guess, beneficiary that you bring is the activism element in order to create value in a stock. Say you've been through that and there's not a great deal that you can add anymore from an activist perspective. Does that automatically mean that the stock is now a sell? Or if the outlook is sufficiently good, then clearly you would like to hold on to that stock and you just become a more normal investor? Or do you feel there's always something that you can bring to the table in order to help management? Just a thought process around that, perhaps.
I think where we have unlocked the value and there's no more upside, which is deep value, I think for us that will be the time to exit that particular investment. However, having said that, if there's going to be a significant upside, let's say in the next 6 to 12 months, I think we'd rather delay that exit until that happens.
Just on that basis, if there were some investments that came to the end of their life and you exited a few of them, are your investors happy to tolerate much higher cash levels within the fund if you don't find that there's another opportunity immediately for you to invest?
I think there's two things. Firstly, their tolerance for us to hold lots of cash, but also the impact that too much cash will have on our returns in our fund, right? So when we did the Bytes UK unbundling from Altron last year in December, we ended up with, I think, about half of our fund, or close to half of our fund in cash, because of the great success that unbundling did. So what we did was we went to our investors and asked for a 6-month period in which to deploy the capital, after which, if we don't find adequate investment, we'll be able to return the cash to them. And our investors were very happy with that. And after the 6 months, we had deployed all the capital. So we didn't have to return anything to the investors.
How much does price play in the investment process? So I think it was Warren Buffett who said that price is my due diligence. But there's also the case that some activists in the US say that they might be willing to pay a higher price to get a foot in the door, because once they are there, they will be able to influence a bit more, have more control on the outcome. So how much is price part of your process, and how do you think about it?
Yeah, I think price is important, but just as a reference point, the most important thing is the value, right? And the intrinsic value that asset has in that what you are looking at. So for us, this is what Anthony was referring to earlier, is you using incomplete information to come up with an intrinsic value, which is not a number you can reference to anything, right? And you almost have to forget the share price of the business. So for us, that's quite important. So this value, intrinsic value, I fully agree. What it means is that if we find a quality business that has all the levers and the characteristics that we think a great business has, it's in the right sector, it's growing at double digit and all these different things, we would be happy to pay up slightly for that business than we would have, a business that's very cheap, but all the metrics are wrong. Management, debt, the sector, so it's, I think quality is quite important in how we make our decisions. There've been businesses where either when we are going into the business or once we are in the business and we need to do bolt-on acquisition for that particular business, we've been happy to pay up for the quality assets, quality additions to that business so that the investment story sticks up.
Once you have identified a target company, do you as a team get together and try to red team each other, try to put a thesis up for debate among different members of the team? Do you try to do a pre-mortem, try to anticipate how things might go and look into the future if things went wrong? Is that in any way part of the process?
Yeah, we don't have red teams per se, but I think the process that we run it's actually more extensive than that. So if you remember, I think I used the example of Net1 where we've spent about 3 years looking at this investment, right? And at different stages of that investment, we would come together as directors and say, guys, we're thinking of Net1, and this is the reason why we think this is a great investment. And other directors will come and say, no, we don't believe this is a good investment for ABC reason, right? Then we shelf it. And then we keep on doing our research. And that team comes back again and say, guys, we think that this is an option time for us to do this investment for whatever reason. And we have these robust debates around why we don't think it's the right time. So that probably happened, Anthony, maybe you've got recollection, probably happened 3-4 times. Right, and at that particular time, Anthony was a great believer in the asset, but the rest of the team didn't believe that it was a great investment at that particular time. But so through that process, I think we work very well as a team because what we do as a team is we meet every Monday to go through the entire portfolio in terms of what everyone is doing on the team. We do check-ins on every Wednesday. And then at once every month, we have detailed portfolio review where we go through every aspect of each investment and the team asks questions. And then for new ideas, firstly, it comes as a new idea, then we allocate resources, then they come back, and then we speak to industry experts, then the entire team weighs in. So by the time we actually decide that we want to make this investment, we've been talking about this thing maybe, I would say minimum 6 to 12 months before it becomes an investment.
That's exactly it. I think the process works really well. It's actually very cautious and thorough. And these ideas do have chance to evolve, over a period of 6 months to a year.
How does the process work to account for acknowledging that you might have made a mistake and you need to remove away from X particular investment?
You've got your deal team, and then once every month, that team has to come and present to the whole team in terms of how our investment thesis is unfolding. And part of that is actually to look at our initial investment thesis and how we're going on with that investment thesis, to look on the value and opportunities that we identified at the beginning and how each one of those are going. And we code those points, green, amber, red, right? Also look at the risks that we had identified, look at where those current risks are. So I think that's quite a powerful way once every month to actually basically the deal team has to justify why that has to continue being an investment for the rest of the team. And I think we have shown that where our investment thesis doesn't stack up, walk away from that particular investment, because the danger with trying to persist with something that's not working is that it sucks up the bandwidth for the entire organization and for the entire team. So we, I think there's someone who says you don't have to make your money where you've lost it. So once something turns out it's not a good investment, let's cut our losses and actually reallocate our resources to something else.
If you could give us an example of a bad decision that was really due to process rather than bad luck, I think that will be interesting for us.
I think the one example that I can think about that was about process was when we invested in a printing and media business, and I think the process failed there because we didn't spend enough time to understand the industry dynamics. The printing industry, the printing industry is in decline. So when you invest in an industry that's in decline, that's just too much force against you to be able to unlock the value for that particular business. The other example that I can think about is when we did an investment but didn't spend enough time really understanding what kind of a CEO the business requires. And that's increasingly something that we spend a lot of time on, because leadership matters. When you get the right CEO in the business, it actually surprises you on the upside. When you get the wrong CEO, it's a total disaster.
I suppose also just disposition-wise, my colleagues help me on this, but I'm somewhat, maybe it's because of age, a little bit process cynical at times. That process is important. Don't get me wrong, process is really, really important. But Sam, I think back to our first investment in Altron, and it's in the past, so we can say it. But we didn't do our full work. we didn't present a full investment committee papers. We didn't have an investment committee meeting. It was actually Sam and I at the time, and we kind of did our work and looked at each other and said, what do we think here? So, and I've also just seen from investment firms and investment banks over the years that sometimes breaking process leads to the very best outcomes and the very worst outcomes, both of those. So I often feel about certain investment firms is that, having process and you follow your process, you generally do okay. But some of the best and worst outcomes, best and worst, come from process breaches. So you also got to bear that one in mind.
That's fantastic, Sam. Anthony, thank you very much for your time and for being part of the Value Perspective.